Scroll through social media for 5 minutes and you'll see it. Someone says they quit their job at 35. Someone else talks about living off 7 income streams. There are screenshots of dashboards, beach photos, and income charts moving up and to the right. The message is simple. Set this up once and money takes care of itself. No schedule, no boss, just assets paying you while life gets easier. That idea feels reasonable when you're earning a paycheck and watching expenses climb every year. If a few assets could replace $40,000 or $50,000 of income, why wouldn't that be the goal? But the real outcomes rarely match the story. Many people who chase these systems spend years building income that feels fragile, stressful, or surprisingly hands-on. Meanwhile, some people who actually live without a paycheck describe something far less glamorous, but far more stable than the beach version everyone sells. Here's the part that's usually left out. Passive income, as it's commonly described, doesn't create freedom. Structure does. The math, the timing, and the psychology matter far more than the label. I'm Alex. Today we'll walk through how living without a paycheck really works, where the popular ideas break down, and why behavior often decides whether financial independence holds up or quietly collapses. Replacing a paycheck doesn't mean doing nothing. It means changing how money flows and how pressure shows up when it does. What replacing a paycheck really means. Replacing a paycheck doesn't mean money magically appears. It means your assets produce enough cash or value you can convert into cash to cover your bills without trading hours for dollars. That distinction matters because most people picture one version and build another. There are 2 ways this actually works. One is cash flow, rent checks, dividends, royalties. Money shows up, you spend it. The asset stays intact. The other is total return. Your portfolio grows over time and you periodically sell a small slice to fund your life. No checks arriving, just controlled liquidation. People argue about which is better. In practice, almost nobody who succeeds uses only one. Pure cash flow looks comforting until repairs vacancies or dividend cuts show up. Pure withdrawals look elegant until markets fall, and selling feels painful. Here's the quiet reality. Living without a paycheck usually means a blend. Some income that arrives reliably, some assets you sell intentionally, and ongoing decisions about timing, taxes, and risk. The mistake is thinking freedom comes from eliminating activity. It doesn't. It comes from changing the rules of exchange. You're no longer paid for time. You're managing a system that feeds you. Build the wrong system and the stress just changes shape. Build the right one and suddenly work becomes optional instead of mandatory. The first fork in the system. Let's pause for a moment before the math shows up. Imagine you wake up tomorrow and without warning, your assets begin covering your monthly bills. Not luxuriously, just enough that your paycheck is no longer essential. Rent or mortgage is handled. Groceries are covered. The pressure eases. Now notice the instinctive response. One option is to upgrade life immediately. Better apartment, nicer car, more comfort because the money feels earned twice. Another option is to push harder. Reinvest everything. Chase efficiency. Try to lock in permanence as fast as possible. The third option is quieter. You change nothing. You let the system run. You watch how it behaves across a few market cycles before touching it. Each choice reveals something. The first increases dependence on the system before it's proven stable. The second assumes the system is fragile and must be forced to grow. The third preserves capacity. It creates room to observe without pressure. There's no judgment here. But this decision determines how sensitive your future plan will be to small errors. Passive income doesn't fail because it's complex. It fails when it's stressed too early. Keep that instinct in mind as we move into math, because the numbers only work if your behavior lets them. The 4% rule and the hidden math. The 4% rule sounds simple, which is exactly why it's dangerous. It says if you invest in a diversified portfolio, you can withdraw 4% in your first year, adjust for inflation, and likely not run out of money for decades. Likely is doing a lot of work in that sentence. Flip the math around and you get the rule everyone memorizes. Multiply your annual spending by 25. To spend $40,000 a year, you need about $1 million invested. Spend $80,000, you need $2 million. On paper, it feels clean. In real life, small changes break the illusion. Recent research has shown that in periods with high stock valuations and low bond yields, that 4% number can be optimistic. Some estimates drop closer to 3.3 or 3.5%. That sounds minor until you do the math. At 40,000 a year, 4% needs 1 million. At 3.5%, you need closer to 1.15 million. Same lifestyle. An extra 150,000 required. And this isn't passive income in the intuitive sense. You're not living off interest alone. You're selling pieces of your portfolio and trusting the remainder to grow fast enough to refill the gap. The rule doesn't fail loudly. It fails quietly, 1 percentage point at a time, until the margin you thought you had disappears. Inflation and the silent pay cut. $40,000 sounds stable. It feels like a fixed target. The problem is that money doesn't stand still. Prices move quietly and relentlessly, even when your income doesn't. If inflation averages just 3%, the math gets uncomfortable fast. In 20 years, the groceries, utilities, and insurance that cost $40,000 today will cost closer to $72,000. Nothing changed in your lifestyle. The purchasing power just leaked away. This is where a lot of safe passive income plans quietly fail. A corporate bond paying a fixed coupon, an annuity that never adjusts, a rental with capped rent increases, while taxes and repairs climb every year. On day 1, it feels conservative. By year 15, it feels tight. By year 20, it feels like a mistake you didn't see coming. Inflation doesn't announce itself as a crisis. It shows up as small compromises, skipping upgrades, delaying repairs, saying no more often. Over time, those decisions stack. This is why portfolios built entirely around fixed income tend to age badly. Stocks, for all their volatility, have historically grown faster than inflation. They don't feel safe in a bad year, but they protect you in slow decades. The real danger isn't market crashes. It's building an income stream that looks steady while it slowly shrinks your life. Flexibility as the real safety net. Most plans fail because they assume perfect conditions, steady markets, predictable expenses, no surprises. Real life doesn't cooperate. Flexibility is what keeps a plan alive when the numbers wobble. Someone withdrawing a fixed $40,000 every year is exposed. Someone who can spend $35,000 in bad years and $45,000 in good ones has options. That difference matters more than an extra percentage point of return. Look at how this plays out. In a down market, selling assets locks in losses. But if your spending can shrink temporarily, you don't have to sell at the worst moment. You wait. The portfolio recovers. The damage never compounds. This is why people with smaller portfolios sometimes do better than people with larger ones. Not because they're luckier, but because their lifestyle is adjustable. They don't need everything to work every year. They need it to work over decades. Flexibility can come from many places. A lower baseline lifestyle, part-time income you can turn on when needed, cash reserves that buy you time, even skills that let you earn without starting from zero again. The math quietly rewards this behavior. Variable spending increases survival rates far more than chasing higher returns. It reduces stress at the exact moment stress causes bad decisions. Safety doesn't come from precision. It comes from slack. The ability to bend without breaking is what separates plans that look good on paper from lives that actually hold up. The cash flow trap. Cash flow feels safer because it looks tangible. Rent hits your account. Dividends arrive on schedule. Nothing needs to be sold. It feels like ownership without erosion. That feeling is exactly what gets people into trouble. Most cash flow is quoted in gross numbers, not net reality. A duplex renting for $2,000 a month sounds like $24,000 a year in income. It isn't. Property taxes, insurance repairs, vacancies, management, and long-term capital expenses all come out first. After that, the real number can be closer to $600 a month, and that's before taxes. The same logic applies to dividends. A high-yield stock paying 8% looks generous until the payout gets cut or the share price drops 30%. Now your income shrinks and your principal quietly disappears at the same time. To replace $40,000 of actual living expenses with net rental income, you don't need 1 or 2 properties. You often need 10 or more units owned outright. At that point, you're not living off passive income. You're running a business with expensive assets and thin margins. The trap isn't that cash flow doesn't work. It's that people mistake revenue for freedom. They count the checks without counting the friction. And by the time they do, they've built a system that requires constant attention just to stay upright. When passive income becomes a job, the calendar is the fastest way to tell if something is truly passive. If it keeps asking for your time, it isn't. This shows up constantly with cash flow assets. A rental that looks quiet on a spreadsheet still generates emails, calls, and decisions. A tenant moves out early. A water heater fails. A city raises property taxes. None of these are dramatic on their own. Together, they turn income into obligation. Even dividend investing has a hidden workload. Chasing high yields means monitoring payouts, reading earnings reports, and watching for cuts. When income drops, you don't just lose cash, you lose confidence. That pressure pushes people to make reactive choices at the worst moments. Here's the uncomfortable part. Many people undervalue their own labor. They'll spend 10 hours a month managing properties or portfolios and call it free money. But those hours have a cost. They limit travel. They interrupt rest. They pull attention back into money management when money is supposed to buy distance from it. Some landlords eventually realize they traded one boss for 20 tenants. The income looks independent, but the stress pattern feels familiar. True passivity exists, but it's rarely cheap. It usually means lower returns in exchange for professional management. And that trade-off forces a question most people avoid. Are you building income to escape work, or are you quietly rebuilding work in a different shape? The hybrid model that actually works. The people who last aren't purists. They don't bet everything on withdrawals or tie their entire future to cash flow. They blend the two deliberately. The core usually starts with growth assets, broad index funds, global exposure, low costs. This part of the system is designed to outrun inflation over decades. It's not there to feel comforted year to year. It's there to keep the engine alive. On top of that, they layer selective cash flow. Not to fund everything, but to stabilize the basics. Groceries, utilities, insurance, expenses that don't care what the market did this quarter. When those are covered, the pressure on the portfolio drops sharply. Here's why this matters. In a market downturn, someone living purely on withdrawals feels forced to sell. Someone with partial cash flow can wait. That waiting is not passive. It's strategic. It prevents permanent damage. The hybrid approach also smooths behavior. You're less likely to panic when you know part of your life is funded regardless of headlines. That emotional buffer is often more valuable than the income itself. This isn't about optimization. It's about resilience. One system grows. One system steadies. Together, they buy time optionality and better decisions. Most failures happen at the extremes. All growth with no buffer. All income with no growth. The middle looks boring on social media. In real life, it's the version that holds up when conditions stop cooperating. Spending is the master variable. Returns get all the attention, but spending quietly runs the show. Every plan is built on one number that rarely gets challenged: how much your life actually costs. The math is blunt. Under a 4% framework, every dollar you spend each year requires about $25 invested to support it indefinitely. That $15 subscription isn't just $15. It represents roughly $375 of capital you need to build and protect forever. A $500 car payment requires something closer to $150,000 sitting behind it. This reframes everyday decisions. Expenses aren't monthly. They're permanent claims on your future balance sheet. When spending rises, the finish line doesn't move a little. It moves exponentially. That's why cutting expenses often beats chasing higher returns. A 1% reduction in spending lowers the required portfolio immediately. A 1% increase in returns depends on markets cooperating for decades. This also explains why progress feels nonlinear. The first 10 or 20% of expenses covered by passive income changes behavior fast. Once housing or food is covered, risk tolerance shifts, job choices widen, stress drops, the danger is lifestyle creep. Income grows, net worth grows, and spending quietly follows. The system stays balanced, but freedom never arrives. Control spending and the math bends in your favor. Ignore it, and no return is ever enough. Sequence of returns risk. Average returns are comforting. They also hide the most dangerous part of the plan. What matters isn't just how much the market returns, but when those returns arrive. Imagine retiring with $1 million and planning to withdraw $40,000 a year. In the first year, the market drops 20%. Your portfolio falls to $800,000. You still need to live, so you withdraw your $40,000. Now you're at $760,000. In year 2, the market drops another 10%. You withdraw again. In less than 2 years, a third of your capital is gone. Even if markets recover later, the damage is permanent. There's less money left to compound. The math never catches up. This is why smooth projections are misleading. They assume markets behave politely. Real markets don't. They deliver losses in clusters, often right when you can least afford them. The psychological pressure is worse than the math. Watching your only income source fall while you're pulling from it triggers panic. Selling feels responsible. Waiting feels reckless. The people who fail here don't fail because they chose bad investments. They fail because timing turned against them before their system could absorb the shock. Sequence risk doesn't announce itself in advance. It shows up the moment after you commit, and without protection, even a solid plan can unravel before it ever has a chance to work. The psychological endgame of financial independence. The hardest part begins after the math works. When the paycheck disappears, something else goes with it that most people never priced in. Work provides structure. It dictates when you wake up, who you talk to, and what counts as progress. Remove it overnight, and the days stretch in uncomfortable ways. A week of freedom feels like relief. A year can feel disorienting. Many financially independent people discover they don't want endless leisure. They wanted control. Without a problem to solve, the mind looks for friction, obsessing over minor expenses, watching markets too closely, arguing online. The stress didn't vanish, it changed targets. This is why the distinction matters between retiring from something and retiring to something. Those who only escape a job often drift back to work within a year or two, not for money, but for meaning. There's also a difference between lean independence and abundance. Bare-bones freedom keeps you alive, but fragile. Abundance buys margin patience and better decisions. The most durable version sits in between. The people who thrive don't stop working. They stop being forced. They choose projects, consulting, volunteering, or creative work on their terms. The real finish line isn't zero effort, it's autonomy. When money no longer dictates your choices, work becomes optional, not oppressive. And that shift changes everything. Key takeaways. Passive income isn't a destination. It's a system that only works when the parts support each other. Math matters, but behavior matters more. Withdrawal rates fail when they're treated as guarantees. Cash flow disappoints when revenue is confused with freedom. And portfolios break not because markets are cruel, but because people are forced to act at the wrong time. The pattern that holds up is flexibility. Adjustable spending beats precision. A mix of growth and stability beats ideology. Margin beats optimization. Most importantly, independence collapses when it's built to escape work, instead of replacing it with something meaningful. The quiet insight running through all of this is that money doesn't buy peace by removing effort. It buys peace by restoring choice. When your system allows you to slow down, wait, adapt, and decide without panic, you're no longer reacting to life. You're shaping it. That's the difference between owning assets and actually owning your time.